Welcome back. You are watching Newscentre. Ratings agency Fitch has raised India's medium-term potential GDP growth to 6.2% for 2023. The revision comes on the back of improved employment rate and increase in the working age population forecast. Fitch's report added that India's labour productivity forecast is also higher. The report also highlighted that while participation rate has recovered from the pandemic slump, it remains lower than the levels recorded in the early 2000s. This is partly due to the low participation among women. The agency has also touted India to have the highest growth potential among the world's top 10 emerging economies. Joining me now is Ojeda-Sierra, Director at Fitch Ratings. Robert, thank you very much for joining us. Fitch has raised India's midterm GDP forecast to 6.2%. What were the key drivers of growth, according to you?
Hello there. Yeah, as you mentioned in your introduction, in this exercise that we do once every 2 years or so, we upgraded India's potential growth to 6.2 from 5.5 when we did the last exercise in 2021, and really it's for the three reasons that you mentioned in your introduction. There's been a modest increase in the working age population. There's been an improvement in the employment rate, but also an increase in labour productivity. These are some of the drivers when we do our potential growth calculations, our estimates of these supply drivers. And also that, some of India's drivers of potential growth, I think they need to improve if India wants to return to the high pre-pandemic potential growth rates. Back in 2019, we were estimated that potential growth would be somewhere in the region of 7%. And as you say, while the participation rate, which is essentially the number of people in the labour force as a share of the working population, while it's recovered to pre-pandemic level, so essentially it collapsed, it's come back up to where it was pre-pandemic, but it remains significantly below the levels that we saw in early 2000, at the start of the 2000, and that's partly because the employment rate among women remains very low. I think, on the positive side, the government has been very focused on increasing capital expenditure on infrastructure, and that should help the investment outlook and productivity going forward. Also, another thing that's positive is that corporate and bank balance sheets are much healthier now compared to what they were in previous years, and that also should support the outlook for investment going forward.
Right. Robert, you spoke about high growth rates in India in the pre-pandemic period. If India wants a sustained period of high growth rates, what are some of the factors that we need to work on for the future?
I think, as we say, while reforms that have been carried out in previous years in key topics or in key areas such as bankruptcy law, the the national tax system instead of having regional tax systems, all these are positive, but I think there's still some challenges facing India, for instance, in terms of the high level of unofficial unemployment, despite the low official level of unemployment, and also I think there's perhaps a need to engage more with the international community in terms of trade agreements. I think from what we've seen before is that many a time free trade agreements have been signed, but growth in exports has not followed significantly because of non-tariff barriers to making sure that exports grow in line. And this is down to domestic issues such as bureaucracy and so on. So forging free trade agreements with advanced countries could yield a substantial inflow of foreign direct investment going forward if some of these factors are sorted.
Right. Robert, in the near term, what are some of the immediate challenges that you see for India? Also, if I were to add the impact of the Israel-Hamas war on India.
This is a tricky situation. I think obviously one of the key impacts on emerging markets as a whole, but India in particular because of its high dependence on fossil fuels, would be if the price of oil surged because the conflict somehow widened to include other countries in the region. If that happened, obviously the price of oil would be much higher. Then we would have to bear in mind what would be the response from central banks if inflation picked up. Would they respond with higher interest rates, or would rates stay higher for longer? Fortunately, the conflict appears to be fairly contained so far, and we've seen this in sort of reflected in the price of oil, which has dropped below $80 in the last day or so. So, yeah, so I think that would be the obvious impact of any escalation of that conflict.
Right. Slowing growth in China, something that you noted in your latest forecast. The reasons for this, could it get more worse from here? And what will be the impact on other emerging economies?
Well, obviously China has a significant bearing on the global economy because of its weight, in the global GDP measures. So we had a better third quarter GDP in China, but some of the fundamental issues facing the Chinese economy, namely the property sector, that will mean a slowing economy as we go towards the end of the year and into next year. Obviously, this could have an impact on global, but also regional emerging economies, namely through, I would say, three main channels, which are well-known channels. The impact on global trade, and that would obviously have an impact on the demand for commodities, industrial commodities. We've seen the price of metals such as copper and aluminium, for instance, dropping quite sharply from recent highs at the start of the year. But also, so aside from global trade and the impact on commodity demand, there will also be an impact on possible deterioration in financial conditions. And I say that because Chinese bank lending is a fairly critical source of funding for a number of emerging markets, smaller periphery emerging markets. So, that's a high level of dependence.
Right. Thank you very much for joining us with your outlook, Robert. With that, we've come to the end of this broadcast. More news and updates continue right here on CNBC-TV18.